Welcome everyone. I am happy to share what is going on for the Bay Area market and what is going on with general just the heat of things. We're going to talk about the recent news articles for the week, and we're going to start off by the inflation print that came out today. For all of you that were hoping for these Fed rate cuts, none of that was a given, and this report shows that we may not expect a rate cut come summertime. As much as people want to say that they're trying to do it because of elections and things like that, if they're trying to hit their target of 2% inflation, this is not the way to do it. So let's see what happens. State Farm indicates where in California homeowners insurance are not going to be renewed and they're going to be dropping. It's not a mystery of the location, but we'll see on a map so you can see for yourself the thoughts. And it's, like I said, it's not a big surprise. The Bay Area is the country's fourth hottest housing market. Let's talk about that. As you guys have been seeing it from week in and week out, as you've been tracking my latest monthly market update about 9 days ago, you wouldn't have been surprised, but there's a few reasons for that, and we'll talk about that momentarily. And last but not least, OpenAI hunts for new offices in San Francisco. The question is where? We'll talk about that momentarily. So let's get at it. Consumer prices rose 3.5% from a year ago in March, more than expected. The CPI index, a key inflation gauge, rose 3.5% in March, higher than expectation and marking an acceleration for inflation. And this is going to be probably still for some time. Because think about this. Shelter and energy costs drove the increase. Energy rose by 1.1% after increasing 2.3%, while shelter costs were 0.4% on the month and up 5.7% from a year ago. If you think about it, the housing, as you can see, is significantly higher right now than it was a year ago, than it was not 2 years ago, but versus the last year. And so if they're using this as a measurement, this is going to be sticky for a while. So unless housing can somehow tank, which really the only way that the housing market will change is if the stock market can tank from basically breaking all-time record highs. And so that's really going to be the real driver. That in combination, if you get extensive job losses, not like just natural attrition, which is what we're seeing these days, but really extensive job losses. Otherwise, this is going to be sticky for a while. Because take a look at this. The target was hoping for 2%, but they haven't raised rates anymore, but they kind of stayed relatively flat in this range of 3 to 4% for a while now. Now, the fact that it's kind of crept back up has not been good for those that have been banking or waiting for lower rates. That's why when I tell clients, don't bank on and wait for lower rates. Like you can see that the general treasury yields and the general mortgage rates had all increased by 50 basis points just today alone. So don't think it's a guarantee that it's going to keep dropping, right? Assume in this case that it's going to be relatively sticky. It may go up a little bit, may go down a little bit, but as long as the math works with those measurements, then you should be fine and you should be good to go. But if not, then you really got to factor that in because it's not looking like it's going to happen anytime soon, especially because a lot of these shelter items are laggards. If they see how much homes have increased, that's going to be certainly not going to be helping these indexes, right? So that's something to be very mindful of these reports. You can see in general, mortgage rates have jumped up a lot today, because the hopes of a rate cut in the July figures is significantly less than it was before. Let's talk about insurance. Insurance has always been a complicated thing in California, in Florida, and State Farm kind of released where they are kind of cutting renewals. And to be fair, I'm kind of surprised that they didn't do it earlier, right? It's really not fair for everywhere to be impacted equally. Whereas there is clearly some areas that are at much more risk than others. Now, the homeowners, this is where it's like such an issue. Like the homeowners had bought it for some price a while ago, and now they may be stuck if there's a lot of insurance providers that don't provide insurance there. Especially many of these areas are in higher fire zone areas, or it could be like landslides and things like that. And so they may kind of be trapped. Right? Because think about this. Some of these insurance premiums have changed from as low as like $1,500 a year to like now it could be like $10,000 a year. Like this is a significant increase, especially for those that may have lived there for some time and they may have like they're living on retirement income, social security, and things like that. And so this has been a really big issue. Now, some providers like State Farm, Allstate, some have just completely not been doing any new policies at this point. But there's also many that are now cutting. That's the next question, because a lot of them already had existing policies. While they may not be establishing new ones, many have been renewing it, but now they're even cutting specific areas. But to be fair, who can blame them? Like these are the bigger proportion of it. The question now is the state will likely provide some sort of offerings for it. But if the state is running it and kind of just filling it as a stopgap, like they're probably not the most capitalized for it in case something bad happens. So that's a different matter if the private players are not into it. So there's a lot of places like California. I think even Florida has a similar situation. Like the state is so involved in the insurance side of things. Like technically they can keep, not necessarily print money, but they can always adjust the budgets. But overall, it's clearly not a free market when it comes to insurance then. But I always wonder too, like if you look at insurance of California, while the value of the homes are significantly more expensive than others, the insurance premiums that you have are way less than a lot of places throughout the entire country. Like a lot of the places around the country are significantly less for the value of the home, even though their labor costs are way less because of the higher risk and also because they let the free market decide. Versus California has always had this overall layer of, in this case, kind of good bureaucracy to kind of cap how much a insurance provider can increase a year. Now, unfortunately, a lot of big providers have left and don't want to deal with California anymore. But at the same time, for those that are able to get insurance, which are still many providers out there, like the amount of premium you pay is actually very little. Like to give you some stats, like $1 million house, like even if it's $1 million, $2 million, $3 million, like let's say that insurance policy right now is $1,500 or $2,000 a year. I kind of think about that ratio. That's like what 0.1%. You look at a lot of other places, their ratio is more than 1% of the insurance versus like everything else. And so that has always been the interesting thing. If any of you have jeweler's insurance by chance, let's say you have a nice watch, let's say you have like nice bags, jewelry insurance, to give you an idea, is a 1%, right? So if you had a $10,000 item, you can have insurance of that, and that's 1% a year, right? Just to have some level of protection on that. So always kind of interesting, like it's two significant things. On one end, it's a lot lower than a lot of these other places around. So technically, we've been kind of benefiting from it for a long time. But at the same time, them not doing it and our policies to kind of keep at a certain range is driving people out, and you're going to see more of these cuts throughout. So those are the downsides of what you see happening. Next, the Bay Area is the country's fourth hottest housing market. As of March 29, the San Francisco, Oakland, Fremont, kind of weird that they chose these three cities. They don't include San Jose as metropolitan area, was the fourth hottest housing market in the country. The Bay Area had a 90-day average market index score of 61.19, according to data in comparison. Seattle, congratulations to the Northwest, the top-ranked metro area, had a score of 64.53. Altos considered anything above a market action index of 30 to be a seller's market. Now, that is kind of simple, right? Because at the end of the day, especially in tech, the tech low point, especially when it comes to valuations, was actually more than 6-7 months ago. If you look at most of the general indexes of the NASDAQ, of the S&P, and these are big drivers for people's income, and also big drivers of their assets, right? You can guess that there's many people that have millions of dollars of RSUs, of stock options, of just stocks that are clearly really tied to the market. So if the market in general are doing really well, then places like the Bay, like Seattle, which has a huge hub of tech talent, especially with very established tech companies. You have places like New York, which is heavily owned, Wall Street, right? These are areas that will do very, very well. Now, I kind of find it weird why they didn't include San Jose. Now, keep this in mind. The reason why you're not seeing the prices, let me see the price one. So the reason why you're not seeing this higher is, remember, this is a 90-day rolling, right? So if it's a 90-day rolling, it's going to look at the past 3 months. And so the past 3 months weren't that interesting. The real big jump happened in March, and it's happening right now in April. February was a decent month, but the January and February weren't anything exciting. So it'll be more interesting to see what happens in the next 1 or 2 months. I think they should have a very good chance to be one of the hottest housing market in the country as you start seeing results. And of course, in the beginning of May, we'll do the April numbers, but right now we're kind of midway through April. It's a big jump already from the April numbers from March. And as anyone that has been buying or selling houses, you'll kind of be able to see just the velocity of where things are at. It's very, very significant. People are hoping and saying, look, Spencer, home prices don't go up 7% a year on average. And then the reality is they actually went up 7-8% in 1 month. I mean, it is what it is. People, if you're putting a much more money down, 30%, 40%, 50%, to have a smaller loan size, the loan amount, the interest rate is not going to be as meaningful because the loan size is just significantly smaller. And to be fair, people are still making a good amount of money here, and that's why you see what you see. Last but not least, let's kind of cap things off of OpenAI. Hunts for new offices in San Francisco's where? Mission Bay. And this is a big part about the general trends. So there is a lot of areas that are not doing well in San Francisco when it comes to the rental space. But if you look across the entire country, the areas that are doing very well are those Class A, really, really nice buildings. And Mission Bay has some very clearly new commercial buildings. So if you're going to be getting office space, because that demand is much smaller, you may as well just get the best of the best, right? You're able to lock in a good deal. You're going to get modern things. But the downside is all those other places in the financial district or downtown San Francisco. Why would people want to move there when you have availability in Class A areas? And that's a big problem with they're going to have to try to figure out, like, how do you resolve this, or what happens with those commercial real estate buildings? We'll see about that. But I mean, at the end of the day, OpenAI is still clearly growing like crazy. They have a big runway. They're just doing incredible things. They're going to be hiring like crazy. And they also still want to be in the ecosystem of AI, which continues to be in San Francisco. So all of those things as a driver are part of the reason why they'll continue to sell their roots there, continue to expand there. But you also may see a lot of other companies go into those areas because they are nicer and newer buildings. Well, if you have any questions or you have any news articles that you want me to go over, leave in the comments below. Otherwise, I'll see you next